There's three types of business funding that you can get for your business, but it's all going to depend on what your business actually does, the type of capital that you need, and where you're currently at in business, meaning how long you've been established. In this video, I want to break down those three types of funding options and which one is going to be best suited for you. So, number one at the top, and by the way, we're going to grade this off of the easiest type of funding to get slash beginner all the way to novice, aka established, all the way through pro, meaning like you want to get the big bucks. And so the first type is going to be no doc, and this is just short for no documentation. This is also referred to as app only. So as we're going through this, I'm going to be breaking down the pros and cons of each of them, so this way you can kind of figure out which one is best suited for you. So I'm assuming if you're watching this, you already have the LLC, it's already set up, it's already established. Like, this isn't going to be the video for you. We have other content around that. This is just going to be around the different funding portion. For no doc, it's going to be the lowest hanging fruit, meaning it's going to be the easiest to get, relatively speaking, if you are just starting out. So we'll go put on here, if you're new, if you have little to no revenue. So I put little to no revenue, aka you don't have any capital coming in just yet for your business. And so the reason why this is important is because typically if you're going to get some type of no doc funding or some type of app only, it's exactly how it says, meaning it's only going to go off of what you put on the application. So it's going to go mainly off of projections. It's going to go off of your projected revenue of what you plan to make in your business. Is going to go off of the expenses that you are going to have inside of your business. And it's also going to go off of your personal credit profile because you're going to co-sign, aka PG, on behalf of the business. The biggest driving force, or at least one of the bigger driving forces to you getting access to no doc funding, since it's typically not going to ask for financials. So you're typically not going to have to provide any type of tax returns. You're typically not going to have to provide any P&Ls or any financial statements or any bank statements for that matter. Is going to be, I would say there's a couple, but I'll give you the three main ones that we tend to see. And that's going to be the business owner. So this is going to be you, the business owner, aka how strong is your credit and are you a high risk to the business? Meaning, have you already taken on way too much debt either for another business or for yourself personally? The second thing that's going to be looked at for this is how the business is structured, because remember, like, banks and financial institutions aren't going off of revenue. So they only have so many levers that they can pull on to determine whether or not you're going to get access to this type of capital. And then lastly is the appetite. And this isn't your appetite. This is going to be the lending appetite, meaning is the financial institution that you're going to, do they actually want to do business with your industry and with your line of work? Those are three main levers that we tend to pull on with clients, and we help them establish when we're helping them set all this up. If they are maybe a little bit newer, so again, this is a new LLC, or if they have little to no revenue. But again, the trade-off for this though is you're typically going to be capped at, and I mean, I'm being generous when I say this right here, you're typically going to be capped at $250K. And this is for an entire like funding, like round, like a couple different products put together, not just for one line of credit, not just for one business credit card. And this is one more thing that I wanted to mention on here is you're going to be capped typically to just credit cards. Now, could you still get access to something like a business line of credit or like a business term loan? Yes, but with where the economy is, it tends to ebb and flow like this. It's an ebbs and flow. Market goes up and down. Financial institutions tend to model what's happening in the marketplace as a whole. And so typically when the market's down, when market sentiment is a bit lower, where consumer debt is a bit higher, especially with, again, with at the time of this video, this could be different 2 years from now. At the time of this video, it's going to typically be capped out at 0% business credit cards. This is one thing that you want to weigh. If that's what you need to rock with your business, might be a good option because it's just going to be app only. But if you're thinking to yourself, I prefer and I would need to have more business lines of credit, business term loans to actually dump into maybe real estate or to actually use as down payments because you can't actually use a credit card to make purchases like that, then let's dive into the second option. So with low doc, this is typically when we start to move into bigger capital. So now you're not just capped at the number that we just spoke on. Now you're not just capped on business credit cards. Now you can start to venture into what we call real cash value credit lines, which are business lines of credit that you can pull from that you can use to cover things like payroll. You can use for down payments for properties. So you can start using this stuff to make bigger purchases. You can also start venturing into vehicles, vehicles and equipment, right? Again, this is all gonna depend on what your business actually needs. Now, when it comes to low doc, the way that this differs from no doc is, I would say, two more steps, which is everything that you'll typically have to provide on a no doc type of funding, with the exception of, at this point, you're typically going to have to start flexing 1 year of tax returns. And then if you wanted to take it a step further, and if you have it already set up, some type of P&L, and then you can also do personal financial statements. If you're wondering, why would this matter? Like, if I can try to provide like as least documentation as possible, I get it, but that's also more of a beginner question. And so now I'm speaking to those of us who are not just looking to have like this proverbial ceiling above us of just business credit cards. Like, that's good, especially if you're credit stacking, you're just starting out 0% business credit cards. That's fun. There's a time and a place for it, right? But now we want to start working. This is what I talk to my clients about all the time. Now we actually want to start working into the big boy, the big girl capital. And so with the low doc type of funding, this is when you start to venture into that quarter mil, 350, 500, 750 dollar mark when it comes to you actually getting capital. So as a matter of fact, I'll put that right here. So 250K, and then there's really no cap to this, but we'll just put 1M for the purpose of just me saving space on my board right here. You wouldn't be able to do this if you weren't going to provide taxes. You wouldn't be able to do this if you are not willing to provide profit and loss statements. And you wouldn't be able to do this if you don't have any type of financial. So something else that you can do outside of personal financial statements is you can also flex your bank liquidity, AKA the funds in your account, because this helps lower your risk, or at least perceived risk, of default to financial institutions when they're partnering with you. But now let's move on into number 3, which is where you can really take your capital to the next level. All right, so if you're still here, it's because you're well established. And because of that, you're going to be able to dominate a market that few people can tap into. This is known as full doc. And we reserve this more for our higher end clients that can start providing real revenue and real numbers for their business when they're looking to break out of, you know, the smaller funding amounts that a lot of people tend to unfortunately get stuck within. But if you're here again, it's because you have a business, and you have a business that has at least 2 years or more of taxes. I'm going to give you guys like some game right now. Like, you guys are going to enjoy this piece if you stuck around. Profit and loss statements, liquidity, meaning you can actually show cash running through. And then this is when you start to venture into that 1 mil plus mark in terms of funding. Now, there's a strategy that you can use if you are a business owner and you've been taking depreciation, and I'll add it here. And if you stuck around, then you're going to get this gem, and that is an add back. An add back simply means that you can re-add any depreciation that you get or that you take from your business to lower, again, that tax liability, and you can re-add that back to your top line. And so what this means is, and again, I'm just going to use simple numbers, but if we went from a depreciation, again, not saying that this would be your business, but if we went from $1 million down to, let's say, 750, then like that tax liability is on the 750, not on the mill. But if you use an add back for the purposes, or for the purpose of going out and getting access to funding, they would actually, when we re-add it back, they would actually use the 1 mil to lend to, not the 750. So the 250 that you took as a deduction, or again, as a depreciation, gets added back. The reason this is important is because when we start to venture into the land of business lines of credit, is they'll typically lend between, depending on where the market is, 12 to right around 22% if they're being more aggressive of what that top line is. So if we have 20% of $1 million, then that is going to be a 200K line. It doesn't always shape out that way. Obviously, there's a ton of different factors that break out, but just to keep the video as simple as possible, that right there off of one product would be a 200K line, not including any other product that we can potentially help a client get. When it comes, one last thing that I want to say, when it comes to full doc, is SBA funding. This also puts you in line with SBA 7A and SBA 504s, which is what people use. I think I'm out of the shot with the board, but 7A 504, which is what people use to purchase real estate and is what people use to purchase businesses. But it all stems from you having this dialed in. And if you stuck until this part of the video, then odds are you have, because if not, you would have already checked out on the data that we gave you earlier. But regardless, if you're here, fantastic. We can work with you if you need help getting across additional funding to continue to support you and your business to take you to the next level. If you're not here just yet, the other two funding options, again, if you need help with any three of these stages, we can help you out. But the other two options are going to be your best bet, because it's going to save you a lot of time on having to wait for some of these funding products. You just have to know what game you're playing. So you have to know, I can't force a door to open if it's just like not going to open. And so if I'm trying to get access to a business line of credit, understand that it's typically going to start at 1 year of tax returns. If you want to get bigger lines, it's going to start at 2-year tax returns. And again, this moves with where the market is. Some of the lending policies could loosen up a bit, but with where the economy is right now, this is what I would prepare for.